Hello and welcome to the ASR Fintech. This episode we cover on timeliness with ROIs. The web explanation, the timeliness of an investment, also known as the time horizon, is a critical factor that directly influences potential returns, acceptable risk levels, and investment strategy. The longer the time frame, the more potential for growth and compounding. Deeper dive, the impact of timeliness on investment returns. In reference to risk-return trade-off, investments for the short term prioritize preserving capital and liquidity, example, high-yield saving bonds, CDs, short-term bonds, and generally offer lower but more stable returns. Long-term investments, example, stocks, real estate, can tolerate more market volatility for the potential of higher returns. In reference to compounding, a longer time horizon allows returns to compound over time, meaning earnings generate their own earnings. This snowball effect can significantly increase the final value of an investment. The rule of 72 can be used to estimate how long it will take for investment to double at a given rate of return, 72 divided by the annual return percentage. In reference to market volatility, over short periods, days, weeks, or even a few years, returns are heavily influenced by random market fluctuations. However, over long periods, 10 over years, markets historically tend to trend upwards, smoothing out short-term dips and increasing the probability of a positive return. In reference to beating inflation, holding cash for long periods can result in a negative real return because inflation erodes purchasing power. Long-term investments in diversified assets like stocks and bonds provide a better chance of outpacing inflation. And in reference to timing the market, consistently investing over time, dollar cost averaging, is generally more effective than trying to perfectly time the market. Missing just a few of the market's best days can significantly reduce overall returns. A finance news as published on CNBC.com on April 26, 2018, headlined, "A 36-year-old who learns to invest like Charlie Munger explains his 4 principles." The article read, when Daniel Town found herself burnt out and even starting to get sick from her work as a corporate attorney, she knew she didn't want to keep laboring at the same breakneck pace for much longer. So she started brainstorming ways to retire faster. "I started to think, what else can I do to support myself without being dependent on my salary," Town tells CNBC Make It. In addition to following Buffett's #1 rule, don't lose money, Town also studied Charlie Munger's 4 guidelines for picking winning companies. Here's how she breaks them down. Number 1, it must be a business you are capable of understanding. Number 2, it must be a business with a durable competitive advantage. Number 3, ideally, the business management has integrity and talent. Number 4, it must be a business you can buy for a price that makes sense. Time your purchase well to make sure that you're getting a good deal. Although this principle might seem the most obvious, Munger lists his 4th for a reason. First of all, you find a company, and that's wonderful. Then you look at the price, Town explains. And only when the price is right, do you then buy, with a margin of safety so that in case you're wrong, there's still a margin of safety on that so that it can go down, it can go up, and we'll still make money. A citation from research paper by authors for the UW Journal of Management Sciences, Dr. Syed Mohammed Ahsan Jilani, Government College University, Faisalabad, Dr. Ahsan Riaz, Government College University, Faisalabad. As published on ResearchGate.net in December 2022, titled, Impact of Firm Financial Ratios on Financial Distress, Moderating Role of Corporate Social Responsibility. The abstract read, purpose, corporations fall into financial distress or even go into bankruptcy due to many reasons. Financial factors are one of the most important factors for financial distress. In previous literature, this element is ignored, that those companies are engaged in social activities. Therefore, this study invested the moderating effect of CSR actives design and methodology. This research focuses on non-financial companies that are listed on the Pakistan Stock Exchange, PSX. This study is quantitative and it deals with secondary data. This comprises data from the year 2012 to 2021. Descriptive statistics, correlation analysis, ANOVA, multiple logistics regressions, and multiple moderated logistics regressions are applied. Findings in the overall sample liquidity, profitability, and activity are found significant and leverage are insignificant at firm-level financial variables. Moreover, CSR only moderates the relationship, liquidity, and financial distress at 10% level of significance, but not moderated with other financial ratios. Implications and future direction. The study's findings will help financial institutions evaluate financial distress and estimate minimum capital requirements to lower the cost of financial risk. The most important limitation lies in this study is that it only includes non-financial firms listed on the Pakistan Stock Exchange. The study measured CSR as quantitative approach by measuring the CSR spending ratio. However, future research may also use a qualitative approach CSR index for better CSR measurement. This has been Dato Alexander Solomon reading you the ASR Fintech covering on timeliness with ROIs. For transcripts and related links, visit alexandersolomonreports.com. Once again, we credit mention for information sources of Google, CNBC.com, and ResearchGate.net. Thanks for watching.